presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac Market Wrap YouTube update for October 28th, 2024. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. Let's start with the numbers. First of all, let me remind all of you, just click on the subscribe button so whenever I post an update, you'll be notified and you can watch it at your convenience. Let's start with the numbers. Looking at the numbers last week, a little bit of a pullback, as we termed the podcast last week, election anxiety. That's what we have in the market. Now, S&P was down slightly, down about 1%. Dow was down 2.66. Small cap, not good, down 2.99%, while the NASDAQ ended gaining up 0.16. So that was the big winner last week overall. Consumer discretionary was the best sector. Materials were down, healthcare was down, and industrials were down. Those were three that I think are impacted the most because of interest rates going up. And I'll show you a chart how these interest rates have really popped up, and they could continue to put some pressure on the market in the short term. Why are interest rates going up? Well, now the narrative is in the market, oh my God, the Fed is going to pause. They're not going to cut interest rates anymore. The economy is doing too well. We're going to get a GDP number this week, around 3% GDP growth, which is fabulous growth in the economy here. We expected to get unemployment data, but unemployment is the employment market is starting to get a little bit weaker. We're expecting 110,000 jobs created, which is way down from what we have been experiencing. Around 250,000 was the amount of jobs created last month. So if we do get a number around 110,000, that'll show some slack starting to develop in the employment market. And that overall will, I think, spur the Fed to continue to cut rates. But in the short term, the narrative is Fed is going to pause. That's why interest rates have popped up. That's why we're seeing a little bit of pressure, especially on the small caps that were down 3% last week. Oil down big today. It's down about 5% after the Israeli strike on Iran. It did not hit any of the infrastructure, the oil infrastructure or the nuclear facilities. It attacked mostly military targets, and that sort of calmed everything down. The Iranians said there was no damage. Israel said, okay, we're done for now. That sort of brought everything down. So the premium that had been built into the oil market was taken out, and that's why we saw a big down move in the oil market. And if we things subside or calm down a little bit more in the Middle East, that could put even more downward pressure on oil, downward pressure on inflation, and that would, I think, help the Fed cut rates in the November meeting. But we did see a big jump in the 10-year note, going up from 4.08 to 4.25. That is a big jump in interest rates. We went right through the 200-day moving average on the yield. We're moving higher on interest rates, and it might be an opportunity for all the people sitting in money markets that have got, I was looking at a number, it's like $6.5 trillion sitting in money markets right now. Has to go somewhere if rates continue to come down. By the time people realize, oh my God, rates are down to 3% or 2.5%, I'm not getting anything, they might look at the bond market, it's already gone up a lot. They might look at the stock market, it's already gone up a lot. So they might miss the boat. So this might be one of the last opportunities for people who want bonds long term, lock in those higher rates for a period of time. They can do so, and that's what we're seeing. One thing we've seen over when the Fed starts to cut interest rates and we do not have a recession. There's only been 3 times when Fed is bringing rates down and we're not in a recession. We see the S&P do really well. I mean, it's already gone up 23% this year. So we might have already front-loaded a lot of this into the market, and it might be that we've seen most of the gains already, but there's more Fed cuts coming, and if there's more Fed cuts, that'll continue to support the stock market in the short term. A lot of data coming out, GDP number expected to be around 3%. That is just a great number if we can get it. Unemployment, 110,000 jobs. That would be way down from what we saw last month of 254,000. So if we get a 110,000 number this Friday, then that would show that the economy is slowing, the amount of jobs being created is slowing, and that'll give the Fed the opportunity to cut rates more. So they have a meeting next week also, so we will see what they do once they make the announcement with the Fed meeting. So that's what we're expecting. Unemployment rate is expected to be around 4.1%, same as it was last month at 4.1%. We're looking at construction spending. We're looking at ISM data coming out. We have car sales coming out. So a lot of data this week. And we have a lot of companies reporting earnings. So far, earnings have been much better than expected. The beats have been the beats. That means how much they've beaten what the expectation was. That has been much better this quarter. So if we continue to get that, I think that'll continue to support the market overall. Looking at the technicals, we bounced off the 20-day moving average 3 times last week. We break this 5,800, 5688 is the 50-day moving average. That should supply some support to the market. But in the long term, I'm looking at somewhere around 5,600 is the 20-week moving average. We've seen, as you can see, come down, tested it quite a few times since last October when we made the low in October, got above this 20-week moving average. You can see we've tested it. 1 week we went below it, but came right back and closed above it. So we've seen this, and that would not surprise me to get this pullback down to here, or even a little bit more after the election. So we could get some more election anxiety over the next couple of weeks, and that could give us an opportunity for the market to pull back a little bit, correct a little bit, but it'll give you an opportunity to take some of that cash and put it to work, buy the stocks that you don't have, that you do want in your portfolio. NASDAQ also continuing to move higher, looking at new all-time highs, are getting closer and closer to it. We're at 18.6, support is at 18.3, then 17.9. Those are the 20-day and the 50-day moving averages. Long-term support around 18,000, 20-week moving average. That's what I would be looking at. But the dot plot turned up, about 1, 2, 3, 4, 5 weeks ago. Once it turns up, as you can see, when these dots are below the market, this is the market, and these dots are below, we're in a bullish phase. You can see that we were down for about 4 or 5 weeks, and then we've turned back up. Usually it turns up, it stays up for a period of time. So I think we might get pullbacks, but overall, I still think the trend is higher in the market. This is the big question. Interest rates, you can see they're up to here. This was the high that we made in July, which was 4.29. We are at around 4.28 today. Break above that, then we head towards here, which is 4.49. And then right about here, which is 4.63. So if we can get up to these levels, we'll have to see what happens in each one of those. If we get above here, then we go to the high of this year, which is 4.73, right about here. So these are levels I would be watching, but this is the first one I'd watch carefully as interest rates go up. If interest rates continue to go up, that could give the market, again, an excuse to pull back a little bit more. Oil down big today after the strike on Israel. I just talked about that. Support is going to be right around here, which is just below $66. We're trading around 67 and change today. Break below 66, then the market could come down, but I think this is going to hold right around $66 is where the low is going to be, somewhere around there. Small caps still stuck in this range, just going back and forth. Looks like a little bit of a flag formation, but we need to break out above here and really break out above 245, which is this high that we made a couple of years ago. So if we can get above that, then the long-term target becomes 258 to 285 for the small caps. But that'll only happen if interest rates are coming down, and right now interest rates are going up, and that is why small caps were down nearly 3% last week. Gold market sort of taking a pause right here. I think it's gone up a lot. We've seen a big move to the upside, support around 2,700 to 26 and a quarter, the two supports. I think around 26, 26 and a half could be an area. If you want gold, you don't have gold, that's where I would take a look at it. Those are my thoughts. Those are my observations this week. Big week, obviously, this week with all the data. Next week with the elections. Again, I will be back with you next Monday before the election, and then we'll see how the election goes. And that's going to really, I don't think it's have a big impact, but in the short term, it could create more volatility. Again, if you want to get this YouTube update, absolutely free, just click on the subscribe button and you'll get that. If you're interested in help with your portfolio, email us at invest@compact.com or just call at 800-388-9700. We'll get back to you. We'll develop a plan for you. We'll show you what we do and how we do it. You've heard me for the last decades talk about the markets. The same consistent message, how to get you from where you are now to where you want to go financially. Give us a call or send us an email, and we will be more than happy to help. Those are my thoughts. Those are my observations. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.